For decades, the world's biggest banks secretly rigged the price of money itself, your mortgage, your debt, your future. It was called LIBOR. Welcome to the Financial Historian, where money, power, and history collide. And nothing is ever as simple as it looks. For years, the most powerful number in global finance was something almost no one outside the industry had ever heard of. The London Interbank Offered Rate, or LIBOR. It wasn't a stock, or a bond, or a government policy. It was the price of money itself. Each day, major banks names like Barclays, JP, and Citigroup were asked a single question. If you had to borrow from another big bank today, what interest rate would they charge you? Every morning, each bank would submit its answer. The highest and lowest were thrown out, and the rest were averaged. That average became the official LIBOR for the day. Simple, elegant, and, as it turned out, catastrophically naive. Because those numbers weren't based on real transactions. They were based on the assumption that trillion-dollar institutions would tell the truth. To understand why this mattered, we have to step back. LIBOR wasn't just a number for banks. It was the benchmark for over $350 trillion in financial contracts worldwide. That includes corporate loans, student loans, mortgages, and credit cards. When you paid interest on your mortgage, when your student debt accrued another dollar, LIBOR was the invisible reference point that decided the cost. It was the heartbeat of the global financial system. And yet, this global benchmark was built on nothing more than a few banks guessing what they thought borrowing might cost. It was like letting students grade their own exams and then paying them bonuses based on how high they scored. Inside those banks, a quiet realization spread. If even a tiny adjustment in the rate could move trillions of dollars, then whoever influenced that number had real, invisible power. And power, in finance, is never left unused. Imagine one trader holds a massive bet that pays off if interest rates go down. He messages a friend in the department that submits the daily rate. Hey, can you lowball LIBOR a bit today? The colleague nods and adjusts the number slightly. When all the banks submit their figures, that tiny adjustment shifts the average. LIBOR falls by maybe 1/100%. It doesn't sound like much, but when $10 trillion in contracts are tied to that number, it means billions move instantly. And every time the rate moved, the traders who nudged it collected the winnings. By the early 2000s, this quiet manipulation had evolved into open collusion. Traders across continents coordinated in secret chat rooms with names like the Cartel. Their conversations, later uncovered by investigators, read like scenes from a heist movie. Can you move 3-month LIBOR down a tick today? Sure, mate. No worries. You owe me a bottle. They joked about fixing the fix and sent each other champagne, all while moving billions that affected everything from municipal pensions to family mortgages. This wasn't rogue trading. It was routine. When the global crisis hit in 2008, banks didn't trust each other enough to lend. But they didn't want to show it. So they began reporting artificially low borrowing rates, pretending they were healthy. In reality, the interbank market had frozen. The system's heartbeat was flatlining. LIBOR, one economist later said, was the thermometer that said 98 degrees while the patient was in cardiac arrest. The truth finally surfaced. In 2012, a series of whistleblowers and investigations exposed the extent of the manipulation. Barclays Bank was the first to admit guilt, handing over chat transcripts that showed just how casual it all was. The scandal spread like wildfire. UBS, Deutsche Bank, J. Morgan, and others were all implicated. By the time the dust settled, the fines had reached nearly $9 billion. But that number was insignificant compared to the profits the manipulation had generated. A few traders were jailed, but they were scapegoats. The institutions themselves survived untouched. To fix the problem, LIBOR was officially retired in 2023. Its replacement, called SOFR, is based on actual transaction data, not estimates. In theory, it's safer, but in practice, it still depends on the same institutions and the same culture that made LIBOR possible in the first place. The LIBOR scandal wasn't really about interest rates. It was about trust. It showed that the financial system isn't cold and mechanical. It runs on human psychology, greed, fear, and the pressure to win. The manipulation wasn't victimless. It was a silent tax, extracted from every borrower in the world. But it barely made the news because the crime was too complex and the villains wore ties. In the end, the scandal revealed something uncomfortable. The global financial system isn't built on precision. It's built on confidence. And LIBOR Scandal was a reminder that the people who control the world as money dante need to break the rules. They just need to write them. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.